Hi, my name is Roger Schluter. This video is actually about the 504 program, the SBA 504 financing program. And it's about three areas where borrowers worry about all the time, and they really don't need to worry about them. So anyway, I mean, the bank doesn't worry, the CDC doesn't worry about them. There's always ways to make the project work. The first one, there is a job criteria, and they always worry about that. Am I gonna have these jobs? What if I don't? What if they don't approve it? The second one is an ownership criteria. You do have to have a certain ownership in the building, and you can lease out part of it, but you're supposed to actually occupy. Your business is supposed to. That's what I call by ownership. You're really supposed to occupy a certain percentage of the business. And then number three is the down payment. So anyway, I'm going to cover those three things in this video. And, these three requirements of the SBA 504 loan, the borrower really doesn't have to worry about, but I know he does. The first one is the jobs criteria. Under the SBA 504 program, the borrower is supposed to create one job per $75,000 of the SBA portion of the loan or the debenture. If they are a manufacturer, then the number goes up to 120,000 per job, which is a little easier to meet. And that's because they like to encourage manufacturers in the United States. There is also the green criteria when the borrower uses less energy usage through energy savings in a new building. And this one you really need to look at the SOP, standard operating procedure, to really make sure you're meeting that criteria. Minorities and women do not have to meet the job criteria. They would have to be a majority owner at 51% or more of the ownership of the project. And that is to be able to, claim that they don't have to create those jobs. There is also another way. There's public policy goals that if the location is in certain low employment areas, the CDC must meet this goal in one way or another. And I've never seen a requirement not be met. I guess an example I had was I had a husband and wife who owned a business 50-50. Well, the woman owned 50%, so you'd think, well, woman ownership. No, she has to be 51%. So we had to go back and tell her husband that, hey, we need to redo the ownership on this, and your wife needs to be 51% owner. Luckily, he said yes to that, and we went ahead and we didn't need to meet the jobs criteria. And they had a retail operation that probably would not have met. She didn't think it would. A lot of times, how we look at the ownership thing is we look at it, or the jobs thing is we look at it. How many jobs will you have if all your stars are lined up in the next 2 years? And I mean, almost everybody meets the jobs there or says they're going to meet them. The way the SBA checks it is they check your projections to see if you actually allotted money for labor for those jobs. And if you hadn't, then they're going to say, whoa, what's the deal here? So anyway, that's how that works. Number two, the owner needs to be a majority occupier of the business property. The owner does need to occupy 51% of an existing building and 60% of a new building. Now, what I mean about that is, they have to actually occupy that percentage of the building. They can lease out the rest of the building. And a lot of times a business will find a building and, the other owner already has part of it leased out. And they at least have to wait till that lease runs out to where they can release it then. But, or they can occupy it, whichever. Usually the SBA says that you have that you are going to occupy the whole building sometime in the future. And that just depends on your growth. So anyway, but those are really, they are used for renovation. No SBA proceeds may be used for the renovation of the rented out square feet. Use it for the regular, but the rented portion. So let's say you have 60%, it's an existing building, you're going to occupy 60%, you're going to lease out 40. That leased portion, you cannot use renovation money for the 504 to build that out. That's all that means. When the SBA says 51%, they do not mean 50. They don't mean 50.5%. They actually mean 51% or more. And to check this, they'll really look at the appraisal. The appraisal always has the square feet of the operating company and any company's leasing space in that building. And always check with the appraiser if the square feet is close to being 50 to make sure you can make that work. I know one way we made that work was that there was a building, and is I guess a one-story building with a basement, and there was a lawyer's office, and then there was I think a dental office, and then there was storage space, and and then there was some office space used for communal areas. But anyway, the actual, the owner was the lawyer, and they did not own quite 50%, but they leased out space, storage space on the bottom. So basically, with the first time we did the appraisal, the appraiser, said they were going to lease out the whole basement, all that space, and they didn't meet the 51%. So we had to go talk to them and say, whoa, wait a minute. There's several spots in that leased out space that are not being used, and those are going to be used by the lawyer's office, and that bumped them up over the 51%. So anyway, and they were going to use that, and those were empty, by the way. They weren't filled with tenants or anything. And this was leased out space like a garage space or something like that. It wasn't like leased out for retail or anything. It was just leased out for people that wanted to store stuff. So it worked out very well. The down payment is kind of the third thing. And the down payment, needs to be cash or land. Cash can be from the business or from the owner, but they will check to see if the business or owner has the cash. Land is used when a building is new and will be built on the land. If the land has been owned for 2 years or longer, the borrower can use the appraised value, which usually they'd rather use. But if the property was bought in the last 2 years, they must use the cost figure. A down payment can be personal cash, shown on the personal financial statement. It can be cash on the business financial statement. It can be retirement money. It can be other assets that you will turn into cash. I mean, cash is one of those things that is there one day and not there the next day. So it's not like it's like a building that's not going to move. Cash is a constantly changing thing. So it's a very hard thing to really show, and it's kind of a very easy thing to kind of manipulate a little bit. But anyway, let's in the summary, the jobs criteria. Let's go back through that. The jobs criteria, the way that it's the last resort is when you look at the property taxes that are generated from the building. Let's say you can't meet that jobs criteria. Then you can actually look at the property taxes that are generated from the building being occupied and justify the benefit from the increase in property taxes associated with the public policy goals. And that'll be, usually you can check, with the county, with the assessor's office, and you can see that these property taxes, if this building isn't sold, it's not going to get those property taxes probably. So anyway, we have had husband and wife ownership, that's 50-50 like I said, and you just change that to the husband 49% and the wife 51%, so that a woman does not have to, and a woman does not have to meet those jobs criteria. So that works out good. The ownership criteria, owners must occupy 51% or more of an existing building and 60% or more of a new building. And you do have to remember that after this loan closes, I'm sorry, but there's no SBA police. There's nobody going to check. The CDC will probably call you and ask you the number of jobs you have because they keep track of that for the SBA. But I mean, if things go bad and your business isn't doing well, you theoretically, I guess, could lease out the whole building. Nobody's really gonna. I mean, usually I think they try to get by and visit the building once a year, but sometimes that doesn't happen either. So if you're making your payments on time, nobody's going to bother you, and nobody's, they may care, but they're really not going to do anything. So anyway, now the down payment. Just remember they have to come up with the down payment at some point, at least by closing. The cash in your personal account or business account are moving numbers, and just because you put down, that your cash is $100,000 when you apply, that number could change from day to day. Just remember that it is a crime to purposefully lie on your personal financial statement just to get the loan. And I need to say that because, in banking we've seen that happen, and we never really find out until, the proverbial house of cards falls apart and the business is shown doesn't really have anything. And then when you check back and say, whoa, you put down all these assets, you should have something, you find out they're all made up. So anyway, that has happened many times with banks, and that's where the know your customer comes in, and that's why with the 504 now they do check. They actually file what is called the 4506 C, and then they do check and make sure that that your tax returns, they get a transcript of your tax returns. So they compare the transcript with the actual tax returns. And then they make sure that you weren't lying on your tax returns. Personal financial statement's a different story, but if you put down you've got millions of dollars, and then when the business goes out of business you don't have anything and you never had anything, that could be a problem. So anyway, I hope you subscribe and hit the bell to be notified of future videos like this. Please also hit the like button if you take away anything from this video. My name is Roger Schlueter, and I will see you in the next video. Thanks.